Live from Tokyo, this is Insight with me, Sherry-Ann, where we dive deeper into the stories that matter with crucial context and analysis. Asia stocks benchmark edging higher ahead of rate decisions from the Fed and BOJ. Markets convinced we'll see a cut in the U.S. and no change in Japan. Bitcoin trading near a fresh record high on optimism over Donald Trump's support, and with major buyer MicroStrategy set to join the Nasdaq 100. The president-elect also helping SoftBank shares gain today, announcing that Masayoshi Son plans to invest $100 billion in the U.S. over the next 4 years. We'll dig into all this with some great guests. Morningstar's Chief Research and Investment Officer Dan Kemp talks market strategy, and we also check the cryptocurrencies with Revo Digital Family Office CIO Zann Kwan. Asian stocks tracking gains on Wall Street, where the tech-focused Nasdaq 100 reached a new record high. Traders bracing for interest rate decisions by central banks across the world this week, including the Fed, which is widely expected to deliver a quarter-point rate cut to close out the year. Japanese markets away on a lunch break right now, but we're seeing a little bit of gains for the Japanese yen at this point, but still around that 154 level as we head towards the Bank of Japan policy decision as well. No change expected there, not to mention that we also have policy decisions in the Philippines as well as Indonesia and Thailand. Let's bring in Garfield Reynolds, who leads our Markets Live Asia coverage and joins us now. Garth, what are the key decisions that you'll be watching out for the markets this week?
Well, there's really only two, as you flagged, Sherry, and that's the Fed and the BOJ. And with both of them, the very strong expectation is that what is going to matter is not what they do now, but what they signal they plan to do next year. The expectation is that the Fed will lean even further into the gradualist tone that it has had, possibly take a rate cut out of the dot plot for the coming year. So signal, say, 2 rate cuts next year instead of the three and a bit that are priced now by the market. And the market was previously looking at 4 or even 5 or 6. And then on the other side of the Pacific, the Bank of Japan, which meets within about 12 hours of when the Fed decides. The expectation there again is that they won't move in their case, so that's very strongly priced. But the question then becomes, what do they signal about 2025? Are they likely to hike in January? That's currently seen at maybe a bit less than a 50% chance. And also, are they going to signal that the plan is to, once they start hiking again from here, to carry out a quote-unquote proper tightening cycle, to declare victory, as it were, in reaching their, ensuring that the expectations are there that inflation will remain at 2% or above over the long term, and therefore they can normalize policy and start to move the rate seriously away from zero, whereas so far they've just been very cautious on that front.
And Garth, with the cautious tone and gradualist tone that you talk about coming both from the Fed and the BOJ, does that mean just more weakness for the yen, which is already trading at that 155 level?
Well, if the BOJ does lean into the gradualist tone that they've tended to have, then yes, that could definitely set off further yen weakness, and there's some potential precisely for that, because even with markets reducing their bets on hikes at the current meeting, they've sort of increased their expectations that they will hike several times, probably over the first half of next year. So if the BOJ shows that it is in particular perhaps open to government pressure, we had government spokesman today saying, of course, the BOJ needs to be independent, but they also need to work closely with the government. And the government has definitely expressed plenty of nervousness about the idea of higher rates. So if the BOJ meeting on Thursday aligns with that sort of narrative, then we could very readily see the yen go to 160, in the coming weeks, especially depending on both what the Fed says and does, and then also what, if we start to get more fulsome ideas about how rapidly President-elect Trump will move to impose actual tariffs and also to carry out measures like reducing taxes, boosting, taking measures that would boost US growth. All of those things speak to the other side of the equation. You sort of think that, in fact, when you're looking at the potential for the way that the US economy could develop going forward, that would in fact argue that the BOJ should definitely be biased towards tightening. Otherwise, they risk sending the yen past 160. But the rhetoric coming out of both the BOJ and also the Japanese government makes it sound more likely that they're going to err towards the softer side on policy. They're willing to take the risk of a significantly weaker yen.
Right. Yeah, we'll be watching those yen carry trades just to see how the currency markets unfolds if we really see that sort of cautious tone coming from the BOJ. Garfield Reynolds, who leads the Markets Live coverage, thanks for that insight. And Bloomberg opinion columnist Bill Dudley also seeing that the Fed is continuing to cut rates into next year. We asked the former New York Fed president what it would take for the U.S. central bank to hit pause on its easing cycle.
Expectation is that they will continue to do rate cuts in 2025. And I think the dot plot will show 2 or 3 rate cuts in 2025. But to your question, what would cause them to not just pause, but to stop? That'd be an economy that continues to do better than expected, inflation that's sticky, and the Fed revising up their estimate of what a neutral interest rate is.
Let's bring in Dan Kemp, Chief Research and Investment Officer at Morningstar, joining us now from London. Dan, thank you so much for joining us today. Given the potentially divergent policies that we might see from central banks, I mean, we do have a solid U.S. economy, but on the other hand, of course, we also have potentially a tightening cycle, even from the likes of Brazil that just carried out a jumbo rate hike. And of course, we have the BOJ. How do you play this?
Well, hello, Sherry. Yes, it's a fascinating time, as you say, that we've got big central banks in different parts of the world moving in different directions. And that is a challenge for investors because it creates a lot of noise, a lot of movement in markets. And it encourages us to be very short-term focused and look at what's going to happen next. Whereas, of course, as investors, often we need to stand back and think about the longer term. So as Garth and Bill were saying earlier, it's not the rate cut this week in the US that's really going to make the difference. It's the dot plots, it's the expectations deep into next year and beyond that are going to drive investors' thinking over the course of this week.
As an investor, how do you hedge?
Well, that's also a really good question because what people have been doing recently is really trying to hedge using cash by having lots of cash in their portfolios. And that made a ton of sense when US interest rates were high. But of course, as US interest rates come down, then that cash is not acting as such a good driver of returns in portfolios. And at the same time, equity valuations have shot up in the US, particularly in those large tech companies. And so when thinking about the risks in the US economy, particularly but the global economy, then we have to think about the slowdown in the US as being one of the key risks. Even though it looks like the economy is doing pretty well, that slowdown is always a key risk. And in that scenario, longer term bonds are normally your best bet. They don't always work in times of high inflation. They can let you down, but normally they are a good friend in times of lower growth expectations. So that's one way. The other way, of course, is to diversify into lower priced assets. So although the large part of the US market looks really expensive, we're seeing great value across the world. And so one of the ways that you can hedge is look for those better priced companies, not just in the US, but also in Asia and other parts of the world as well.
When you think of Asia, do you consider China in there? Because, of course, there are so many other idiosyncratic risks in that economy.
So we absolutely do include China in there. As we look at the China market, what we see is obviously a lot of economic uncertainty, and there's been some disappointment recently and some offsetting stimulus by the government. I'm sure that conversation will continue for a while, and we don't know when investor sentiment will turn, when people become more positive. What we do see is some great companies in that technology space, in many cases, large companies, well established, well capitalized, that are doing well. And are very underpriced because there's so much sentiment against them. And so as an investor whose job it is to take that long-term view on companies, then we see lots of opportunities in China, despite all the concerns we're seeing about the economy and stimulus and other things.
And because of those concerns, of course, we see the Chinese bond market continuing to rally to new records every time. Will this trend continue into 2025? And if so, what does that necessarily mean for the equity space?
Well, I think from an equity and bond space in China, we probably need to separate those as having different drivers. And so when we look at the bond space, then you've really got to go deep into not just the government bond and the municipal bonds, but also deep into the type of companies that are issuing bonds there as well. So the Chinese bond market really shouldn't be summarized in one view from me, and think about it separately from the equity market. We see great value in the equity market. We see less opportunities, fewer opportunities in the bond market. But in bonds, if people are looking for protection, that's when we would tend to focus on the US, as I mentioned earlier, normally being that best friend in times of trouble.
Anything that can be salvaged in the property sector, especially when you have authorities now pledging more support?
Well, we haven't seen all of the challenges play out in the property market, of course, but we do see some light at the end of the tunnel there. This challenge in the property market has been going on for a long time, but our analysts are seeing some good value in Chinese property stocks. And so, as with any cyclical assets, normally people are at their most bearish when prices are at their lowest. And so we want to look for opportunities for that to turn around and maybe see some longer-term opportunities there. But people don't need to focus too much on the property market in China. It's an important part of the economy, of course. But when there's, as I mentioned earlier, these great technology companies that are very undervalued because of the broad-based negative sentiment, then people can go for much more solid, less cyclical opportunities in that market, rather than having to try and call a turn in the property market.
Dan, there's been a lot of optimism about valuations across the Japanese markets as well. With the Bank of Japan perhaps being a little bit more cautious on its tightening cycle and this continued pressure on the yen, what does that mean for investments across this economy?
Yes, it has been one of the great stories of the last couple of years to see the Japanese equity market come roaring back when people have been so negative on it for so long. But again, taking that longer-term perspective, it now feels fully valued at that market level. And there are fewer opportunities for investors that are taking that valuation lens. As we do at Morningstar, we're always thinking about valuation, and there are fewer opportunities there. Unlike the last decade, where there's been great opportunities in Japan, we're seeing fewer there now. Most of the attraction in the Japanese market is coming from the cheapness of the yen, which you mentioned earlier, is trading at a very deep discount to the US dollar. Again, that could persist or that could change for a little while, depending on how the central banks move over not just the coming week, but the next few months. But over the long term, we tend to see currencies move towards their fair value more often than they move away, and so there's likely to be some boost from the currency there. But it's worth remembering that you can separate the Japanese yen from the equities. Equities look pretty fully valued in most cases, and if we do have a higher yen there, that again could erode some of the optimism in those exporter companies in Japan. So we would look elsewhere in the region for value when it comes to equity investing.
Oh, I want to go elsewhere, but I'll wait a little bit for that. Before I move on, most CEOs here in Japan that I speak to do not mind the weakness of the Japanese yen per se. They just don't like the volatility, the uncertainty, and the pace of the losses against the U.S. dollar. At one point, does all of this become a hurdle for these Japanese companies? And I think it's worth emphasizing for our viewers. I mean, we always think of Japan as an exporting country, but it's not as big of an exporter as it used to be in the past, right? I mean, it does have to rely on domestic consumption, and demand really has faltered.
Yes, Sherry, that's absolutely right. That we can get hidebound in our views of countries and markets, and it doesn't export as much as it used to as a share of the overall economy and market. And so we do need to think about the benefits and drawbacks of yen strength on that broader economy. And so we would expect the yen strength to have some benefits for domestic consumers if that comes through. But at the same time, of course, there's the challenge of high rates that go alongside that typically. But it is a hurdle to exporters, and you're absolutely right again. It's not really the level that causes so many problems. It's the volatility. So there are definitely challenges for exporters. There are challenges for the central bank there, and the valuations, as I say, don't look as attractive as they have done for most of the last decade, which is why we tend to be focused elsewhere at the moment, having been really optimistic on Japan, as I say, for many years. It now looks like there's fewer opportunities there. Now, that doesn't mean the market can't keep going up. Momentum is a really strong force in investment, but for longer-term investors, we're seeing better opportunities elsewhere in the region.
I want to talk about that elsewhere in the region. Dan Kemp, Chief Research and Investment Officer of Morningstar, is sticking around. We'll be talking about other markets, also artificial intelligence. Still ahead this hour, Bitcoin's ending the year with a bang, hitting fresh record highs above $100,000. We'll talk about what's next for cryptos with Zann Kwan of Revo Digital Family Office. This is Bloomberg. Welcome back. You're watching Insight. SoftBank shares are higher in Tokyo after President-elect Donald Trump announced that the Japanese company is planning to invest $100 billion in the U.S. over the next 4 years.
Today, I'm thrilled to announce that SoftBank will be investing $100 billion in America, creating 100,000 American jobs at a minimum. And he's doing this because he feels very optimistic about our country since the election.
My confidence level to the economy of the United States has tremendously increased with his victory. So because of that, I'm now excited to commit this $100 billion and 100,000 jobs into the United States.
Our sources say the investment pledge is to create jobs focused on artificial intelligence and related infrastructure, including data centers, semiconductors, and energy. The Japanese billionaire joins other technology executives angling to win favor from the incoming administration, including OpenAI CEO Sam Altman, who's giving $1 million to Trump's inaugural fund. Dan Kemp, a Morningstar Chief Research and Investment Officer, is still with us. Dan, thanks for sticking around. We saw the investments into artificial intelligence in 2024, into chips, infrastructure. What will the opportunities in AI look like in 2025?
Well, Sherry, our view that we published in our Outlook recently is that we're going to see a shift in 2025. In 2024, as you mentioned, it's all about the picks and shovels of AI, which really means NVIDIA and some of the companies that support it. And we think in 2025, the focus of investors, the focus of businesses is going to shift from just those manufacturers of the kit that supports AI, the chips, and other equipment onto businesses that can use AI to increase efficiency, increase productivity, increase customer service, really use AI in their businesses. We've seen lots of businesses try to do this with various degrees of success over the last year, but I think that's where we're going to see the focus in 25, because we've seen such a growth in the value of the dominant AI companies in 24 that there doesn't look to be as much room for them to grow. So a shift in the focus of investors, a shift in the focus of businesses from buying and building AI to deploying AI to help their customers.
One of your preferred stocks is still SK Hynix in South Korea. Do you see more potential there, especially around hardware, especially around chips across Asia?
Well, that's right. So we like Korea as a market, but one of the reasons we like Korea is because Samsung was very undervalued, and SK Hynix, as you mentioned, is round about fair value in our estimates. But again, if something's at fair value and it's engaged in this new area of development, then there's plenty of room for valuations to grow. And so that's a very specific idea, a very specific opportunity, rather. SK Hynix, as you know, is not just a leader in traditional chips, as Samsung is, memory chips rather, but is also an emerging leader in high bandwidth memory, which is the memory that supports a lot of AI development. And so SK Hynix has a lead there, which our analysts have identified as being a real tailwind for that business. Of course, other people recognize as well it's not as cheap as Samsung is. It recently disappointed on the high bandwidth memory chips, but we're seeing that opportunity for long-term value creation from those companies. But that's a microcosm. When we look at the broader market for AI, generally, we see the focus being on large companies that can deploy AI rather than the manufacturers that dominated this year.
So where are those companies? Can you tell us about the sectors or even some of your top calls?
Well, that's one of the most exciting things about this market, because so many companies can use AI to improve their productivity and also their customer experience. And so in our Outlook report, our analysts call out Walmart as a business that was very successful in deploying AI to improve its productivity. But even some of the big tech stocks that we typically think of as being leaders in this area, so Alphabet, for example, so our analysts believe that that's really undervalued at the moment, as is Microsoft. And so with these large stocks that are using AI already and deep in their business, have opportunity to do more, then there's still opportunities, it seems, for the long-term investor. That doesn't mean it's all going to go up in a straight line, of course, but it does mean that there's benefits for investors in taking that longer-term view on these potential winners at good valuations.
Dan, just quickly, are you concerned about the tech rivalry between Beijing and Washington and potentially more tariffs in this sector?
Well, Sherry, I think everyone is concerned about tariffs. It's dominating the news. It's dominating the minds of investors. And we know that tariffs aren't really good for anybody. And so I think everyone's hoping that a lot of the tariff news that we're hearing doesn't lead to actually increased tariffs. There's a couple of things, though, to bear in mind. The first is that politicians don't always get what they want, and they don't always do what they say, because it's a negotiating tactic. And so when thinking about investing, it's better to look beyond the uncertainty around tariffs into those long-term valuation-driven opportunities.
Dan Kemp, good to have you with us. Thank you, Chief Research and Investment Officer at Morningstar. And Bitcoin right now trading at record highs. We'll be talking to Revo Digital Family Office's CIO next. This is Bloomberg. Welcome back. You're watching Insight. Take a look at how Bitcoin is trading right now, around record highs, still boosted by Donald Trump's support for digital assets and also MicroStrategy's inclusion in the Nasdaq 100 index. MicroStrategy says it's bought an additional $1.5 billion of Bitcoin, bringing its total holdings to around $45 billion. It's expected to raise more equity to plow into original cryptocurrency. Let's get more on Bitcoin's rally with Bloomberg crypto reporter Subhashri Ghosh. Subhashri, so is there no stopping Bitcoin's rally at this point? I mean, we have seen incredible optimism about the cryptocurrency, but at the same time, now with MicroStrategy getting into the Nasdaq 100, does this mean more of an institutional seal of approval?
Absolutely, Sherry, you're bang on right on that inference. Yeah, MicroStrategy, which is a .com era software maker, has transformed itself into a Bitcoin accumulator. And as you rightly said, that it was announced that they are now they are going to be part of the Nasdaq 100 index. So that means that, more of these index funds and companies can potentially buy their shares. MicroStrategy has been selling its equity to raise money and in turn buy more Bitcoins. And given that it will soon be included in the Nasdaq 100 index, that gives more firepower to the company to pile on to Bitcoin, which is already a constrained supply. As we know, it is a fixed supply. So that adds to the demand-led increase in prices that we are seeing this week.
And yet, I guess the key question is whether investors are getting ahead of themselves. How sustainable do you expect this rally to be into 2025?
That's a very important question, and to be honest, whoever we are asking this question, they are laughing it off. There is no skepticism, there is no concern that is still priced into this massive rally that we are seeing in Bitcoin and cryptocurrency markets overall. However, some kind of sane voices do tell us that one is, if the leverage of MicroStrategy really goes up, that could be a point of time when they could, pause or ease up on buying Bitcoins, and there could be some corrections in the prices at that time. Another is, of course, we know that President-elect Donald Trump has been a crypto supporter, and there could be some sell the news kind of a correction when he assumes office next month. So these are the key factors. But I would also reinstate or highlight that overall the optimism is very strong in the Bitcoin markets, and we are seeing call option strikes at $150,000 in March and $180,000 for Bitcoin in June, which really indicates that the rally optimism is very strong, at least as of now.
Bloomberg crypto reporter Subhashri Ghosh there with the latest on crypto markets. And Zann Kwan is MD and CIO of Revo Digital Family Office, which enables ultra-high net worth families to access and invest in digital assets. She joins us now from our Singapore studio. Zann, great to have you with us. I mean, Subhashri just told us that there's almost no skepticism right now about this rally continuing into 2025. Do you caution your clients at all at this point, or do you go with the flow?
I think right now, Bitcoin is 15 years old, right? So the benefits, the advantages of the technology itself and Bitcoin as a separate asset class has been spoken about for a decade. And I think right now what we are seeing is that Bitcoin as an asset class is a good asset class to allocate into to avoid or to minimize the debasement risk in other asset classes. And if you look at the relative value of Bitcoin versus other assets, so Bitcoin hover around the fifth biggest to the seventh biggest asset among the biggest asset classes. We are talking about comparing it into gold and compare it into with Microsoft, Apple, and Nvidia. So right now, Bitcoin hover between fifth and seventh position. I believe at the end of I would say 12 to 18 months, Bitcoin will be the second biggest asset right after gold.
Oh, wow. So what's a price level that you're thinking of?
I mean, in terms of, I would like to not pinpoint a value, but if Bitcoin were to overtake as the second biggest asset, it will at least double from the current position. And I think in the longer term, right now we are talking about how much or what is the US dollar per Bitcoin. I believe when Bitcoin come of age, we are talking about perhaps per Satoshi, right? One Satoshi is 8 decimal point for Bitcoin, and in a way, it's almost like a share, split in the traditional finance world. So we quote one Bitcoin, probably in the near future, we will just quote per Satoshi.
So when you're talking to your clients, do you tell them to invest directly in Bitcoin? Do you do it through ETFs? What's the best sort of format to go about putting your money in cryptocurrencies? And is it just Bitcoin, or are there other coins also that you like?
Sure. And when we actually advise clients to allocate the space, we don't just look at the liquid asset, which right now is I would say, the darling of the market, right? So when we talk about liquid asset, there are 1,000, 2,000 in terms of tradable tokens. Some are available on centralized exchange, and some are available in the decentralized finance and DeFi market. And what we are looking at is that right now all eyes on Bitcoin, but let's not forget that Bitcoin constitutes 55% of the entire cryptocurrency market cap. And let's not forget the rest of the 45% of the altcoins. So altcoin is defined as any tokens other than Bitcoin. So for this bull run, and for the past 3 bull run as well, if you look into the price movement, we will see Bitcoin rallying followed by the altcoin. So in terms of risk, advising my client, in terms of allocation, we are not just looking into the liquid tokens. We are looking into the private equity, the venture side of digital asset business in blockchain. And the risk that we are trying to close right now, the gap we're trying to close right now, is educational risk. Because with that, it's really about educating the client why Bitcoin, why digital asset is up and coming, and the asset class that wealth holders should allocate into. And we are talking about not just 2-3%, and I think some of the families are allocating as much as 10% of their total AUM into digital assets.
I want to get back to the bull run point, though, because right now we're seeing a lot of optimism about what potentially an incoming Trump administration could do, right? But he's talked about a lot of things in the past that have not necessarily come to fruition. This time around, he just spoke about doing something great with crypto. He's also floated a national Bitcoin reserve. But could there be a pullback if we don't necessarily see all of this optimism actually play out in concrete steps going into 2025?
Right, and when you mention about countries, nations putting sovereign wealth into digital asset, the other development is corporates. We are seeing also big corporates doing treasury management in digital asset. I think the 3 pillars of development have to develop at the same time. Right, one part we are talking about digital asset as an asset class that is suitable, right, for treasury management and for strategic sovereign reserve. And the second part is the whole ecosystem, the tax regulation in terms of taxation, accounting, and regulation. The framework of it needs to mature and develop as well. And of course, the third part is the liquidity. And we are not just talking about Bitcoin. How about other tokens? Is it just Bitcoin that sovereign wealth is allocating or stacking up? Or are we talking about other major pillars, right? And I think right now we are starting with Bitcoin, but I wouldn't be surprised that later on both sovereign reserve and corporate reserve will constitute other top 10 or top 20 tokens, or maybe even an ETF of an index of top 50 tokens.
Wait, so are you saying that the National Bitcoin Reserve in a way is a feasible idea and that could actually spread to corporates as well?
Yes, I would say that, of course, right now we are not seeing major, there are a lot of talks around it, right? A lot of rumor, certain countries are going to go in a big way. But I think right now, if you just look at the value, look at the maturing of the entire ecosystem, definitely I think there's a very high chance that more countries and more sovereign wealth will be allocating into the space. And of course, when we talk about that, we are already seeing, having talks with some companies, some listed co as well, contemplating and having a feasibility study on whether allocating into the top liquid tokens, including Bitcoin, would be a feasible treasury management plan.
Do you think there's enough of a regulatory framework, especially connected regulatory frameworks around the world, to actually allow this to happen in a safe way?
So there are two keywords that I'm hearing from your question, right? One is the harmonization and whether it is adequate. I think for the past 5 years, including our local regulator MAS, have been looking at multiple angles into the regulation. We started with the digital payment token regulation, and Singapore followed by the stablecoins regulation. And we started to expand the scope to include custody of digital asset. I think you hit on the right thing, because being a borderless asset, Bitcoin digital asset, it's hard to have a silo regulation, and you can't really go far with countries having their own regulation without harmonizing it across the globe. For example, certain limits in terms of enhanced KYC, or certain limits that you need to get more information on. And I think we are moving in the right direction. So that's one. And I think the other aspect is accounting, the harmonization of accounting treatment and regulations also in taxation, right? So I think with that, what we are seeing and what I think that we will see in the market in the next 5 to 10 years is the coming of age of all the regulation, the measurement, the definition of certain tokens, whether it is a commodity or whether it is payments, or just like a currency, for example. I think with that, we are seeing that it will become clearer, and obviously with that, you will see more treasury, maybe sovereign or corporate, and high net worth allocating more into the space.
Who do you think will take the lead? I mean, we have seen big moves in the European markets when it comes to crypto regulations, and of course, it's always a first mover advantage to sift them across new technologies. But interestingly, here in Japan, when it comes to stable coins, they've managed to make a pretty strong legal system, which has to be matched around the world.
Yeah, it is inevitable. When you look at stable coins, you can see it as a bloodline of the digital asset, because a lot of time from traditional finance from the fiat world, before you go into digital asset, one of the first station of call is stable coins. So that is why you see that not just Singapore, you see markets like Hong Kong coming up with more clarity in terms of stable coins regulation. And what we are seeing in the market, you have seen record inflow in terms of market capitalization of various stable coins. And obviously, you look at what happened in the market 2 years ago, where we have some debacle with stable coins. And what we are seeing is that going forward, because of what happened in the past and what we have learned, stablecoin, in terms of regulation, in terms of inflow, they're just going to get clearer and stronger.
Right, Zann Kwan, Managing Partner and CIO at Revo Digital Family Office. It was really great talking to you as we continue to see Bitcoin trading near record highs. Now, the head of the BlackRock Investment Institute says big forces at play are transforming the global economy. Jean Boivin told us that investors need to look beyond microeconomics to take advantage of AI and the energy transition.
This is not a cycle, right? So we've been spending the whole year thinking about soft or hard landing and the Fed in that context, and we're going to hear this week, of course. But we've been of the view that this is not really the right framing. This is not really about an expansion that can turn into recession. It's rather more about a transformation, big forces that are transforming the economies. And that leaves us, paying attention to the AI team. That's clearly like a big story. We think there's more opportunity in 2025 there to be generating returns. It's about, geopolitical fragmentation that's going to have implications, energy transition. So these are all these things that will have profound effect across asset classes. But they're not like a cyclical story.
So when I hear transformation, when I hear AI, I think tech, and I think tech stocks in particular. But is that too narrow? Where else can you broaden that to?
Well, it starts there for sure, because we're in the first phase, right, which is right now to build out this this AI capabilities, these factories of intelligence. As we build that out, we need to build it out first before we really get the application. So during the course of 2025, I guess that's going to evolve towards the applications, the phase 2, and trying to get more visibility on where we're going to see the big benefits and the revenue streams out of this. And I think that's where like the active management will and the skills will matter more in 2025, whereas now it's mostly about the build out and a few companies.
If you believe in the benefit here, the heft of a few companies, and if you think about the AI promise that many investors have been betting on through the course of this year, what do you then tell investors, Zann, of the people who are betting on the broadening trade? Do you believe in it?
Let me start by saying that the concentration we've seen in the S&P 500 and the markets more generally is kind of a feature of this transformation. It's not necessarily a bug. So I guess the first thing that I would say is that like you need to be careful to be reading too much in the concentration as being a red flag. So in fact, we think it's a feature, not a bug, as I said. And eventually we think it's going to broaden out, but that might take some time. So I think like not get too nervous about the concentration is the first point, and be on the lookout for broadening out over the course of 2025. But that might not happen overnight.
The BlackRock Research and Investment Institute Global Head Jean Boivin speaking with Bloomberg's Katie Greifeld and Shonali Basak. And still ahead, could 2025 herald better relations between the U.S. and Chinese presidents? Bloomberg opinion columnist Karishma Vaswani thinks there's a chance of bromance. She explains why. This is Bloomberg. German lawmakers have voted to hold a national election in 2 months, backing Chancellor Olaf Scholz's plan to end his term early. Scholz called the confidence vote after he fired Finance Minister Christian Lindner, which meant his coalition lost his majority in the lower house of parliament. This sets the stage for an election on February 23rd, 7 months earlier than scheduled. Canadian Prime Minister Justin Trudeau will name Dominic LeBlanc as the country's new finance minister. That's after Chrystia Freeland's surprise resignation, citing differences over how to prepare for the incoming Trump administration and its threat of tariffs on Canadian imports. She had been leading a cabinet group to develop strategies on how to respond to U.S. policies. And speaking of Trump, Bloomberg opinion columnist Karishma Vaswani thinks 2025 might see better U.S.-China ties. Karishma joins us now to touch on a potentially blossoming, quote, bromance. Karishma, good to have you with us. I mean, we have seen this consensus in Washington, which really doesn't happen very often. That's really anti-Beijing. They want to restrict China's growth, especially in big tech, advanced tech. What makes you think that we could actually see this relationship reinvigorated in a positive way?
Yeah, that's excellent context, Sherry. And I think one of the reasons why I'm hopeful, cautiously optimistic, is because, frankly, the alternative is that the situation will get far, far worse, and that means an eventual conflict between the two sides. Now, we can never rule that out between the U.S. and China. As you point out, the era of strategic competition has now become something that both sides of the U.S. political aisle agree on. But what I am seeing, and what I've written about in my column, is the fact that we saw this sort of gesture of relative goodwill from Donald Trump inviting Xi Jinping to his inauguration, a publicity stunt perhaps, but an effective one. It was a smart move. Now, from the Chinese side, there's been no official confirmation at this point whether Xi Jinping will attend. It is highly unlikely that he will do that. But getting the two sides to sit down in a face-to-face meeting, preferably in the first quarter of 2025, before, those eventual potential tariffs that Trump has talked about on the campaign trail, with that potential lineup of China hawks in his cabinet. It is essential to get the two men at the negotiating table so that they can have a discussion and build that rapport, that goodwill that Donald Trump, to be fair to him, has been quite good at doing with other world leaders and Xi Jinping in his first term.
How much tougher will it get to actually get to a sit down if we do in fact see Trump implementing those tariffs? I mean, we have seen President Trump in the past say one thing and then do another.
Yeah, absolutely right. Mercurial, I think, is the best way to describe him. Another word I've used is transactional. And I think that these tariffs are being used as leverage. They're a way to get China to the negotiating table. They're a reminder of what Trump can do, even though in the last term he talked up that warm relationship. He's talked about it again between him and Xi Jinping. He still implemented those tariffs and set the wheels in motion for the trade war that defined his administration and then was carried on by the Biden administration. I think that's very much what we're looking at today. If indeed we don't get some sort of rapprochement in the first quarter before those eventual tariffs, if indeed they are implemented at some point during the first few months of his presidential term, I think it will be very hard to get the two sides to the table, partly because it will be really, really difficult to build trust on the Chinese side. Now, Xi Jinping is in a very difficult, relatively difficult position right now in comparison to what he was in the last time that Donald Trump was president. You're looking at a weaker Chinese economy. You're looking at public sentiment in China, a far worse situation than it has been. So he wants the situation to improve. But the two sides are going to have to find a way to come together at some point next year.
And yet President Xi, of course, has established what the red lines are, especially when it comes to Taiwan.
Yes, and you and I both know just how much of a red line Taiwan is. I mean, just take a look at the naval exercises last week around the Taiwan Strait. According to Taiwanese officials, those were the largest in decades. And Xi Jinping has consistently talked about the fact that national rejuvenation for China, I should say, is all about ensuring that eventually there will be unification with Taiwan. And whether that's by peaceful means or through force, he has said that, you know, it is part of the plan. And this is something that is consistently part of the rhetoric from Chinese policymakers as well. We heard from Xi Jinping during the APEC summit last year when President Joe Biden sat down with him and talked about those red lines. And it's always at the top of the list. Now, what is interesting on Donald Trump's side is that it does look, from what he has said before, and as you point out, can we really trust everything that he says all the time? He does change his mind. But from what he has said in the past, it looks like Taiwan is up for grabs. It could be a bargaining chip. Now, from officials I've talked to on the self-ruled island, this is extremely worrying. They were in the past able to sort of rely on the Biden administration to some extent. I don't think they're as confident they'll be able to do that with Donald Trump in the White House in 2025.
Bloomberg opinion columnist Karishma Vaswani, they're joining us from Singapore. Do check out her opinion column today on the potential of bromance between Chinese President Xi Jinping and, of course, the incoming Trump administration. But right now we're seeing a bit of a mixed picture across markets in Asia. The MSCI Asia Pacific now holding steady. We do have some downside on energy and material stocks. That's it for Insight. Horizons Middle East and Africa is next. This is Bloomberg.